any discussion on momentum indicators must invariably start with the RSI, also called the Relative Strength Index. The RSI was created and developed by Wallace Wilder, where he mentioned this indicator in his book called New Concepts in Technical Trading Systems. At that point of time, the book was published in 1978-79, and I must tell you that the book was almost revolutionary in nature. He used calculations to create not just the RSI but a variety of indicators. Some of them are still being used and are very popular. But we talk about the RSI again. Wilder created the RSI as what he thought would be an indication of when the markets are ready to come down and when they are ready to go up. So we can talk about those indications of going up and coming down as overbought and oversold. The market, he said, can come to a point where the buying is saturated. So stock prices or any instrument prices will either come down or go sideways. That's the oversold area for the indicator, for the RSI which he created. There are times when the market has become oversold, when there are far too many sellers and there is no one left to sell to. That's the position when the market becomes oversold. Once a market is oversold, then the next step is for the markets to either start rising or go sideways. It could be either of the two. Wilder then created the RSI to depict and identify these two states. He used the RSI to identify overbought, or the point at which buying is saturated, and oversold, or the point at which selling is saturated. Wilder created the RSI using closing prices. This seems reasonable because at that point of time, when the computers were not there, when online rates were not available, closing prices were the easiest method of calculating any indicator, not just the RSI, because closing prices were easily available. So the closing prices were used for the calculation of the RSI, and the RSI had an additional requirement of providing the number of periods over which it was calculated. Wilder suggested using 14 as the default period for the calculation of the RSI. I don't know if he was very clear about why 14 was used. I think there are two reasons or two justifications for 14. One is that 14 is a moon cycle approximately, and the second is that 14 is half of the monthly cycle, say half of a month, especially when you say trading days. So for whatever reason, Wilder felt that 14 is the default value for the RSI. So he calculated the RSI and explained it in his book using the 14 value as its default. Even today, almost after 40 years of his book, 50 years I think, 50 years of his book, the default RSI continues to be calculated at 14, and any number of traders have never changed it. Apparently, they are still happy with the value 14 to be used for calculation of the RSI. That's the background on the RSI. The RSI itself, after the calculation, gives a single line, a line that moves between 0 and 100. Therefore, since the RSI always moves between 0 and 100, it is also called a bounded indicator. The Wilders did not call it a bounded indicator. This is simply a concept of technical trading maths, that any indicator that is within a boundary is a bounded indicator. Now the point of a bounded indicator is this, that it cannot exceed 100 and it cannot go below 0. In this case, where the boundaries are 0 and 100. Wilder said when the RSI goes up, it suggests buying pressure is stronger. When the RSI comes down, it suggests selling pressure is stronger. Wilder's RSI has a range between 0 and 100. So as the RSI moves downward towards 0, it tells us that selling is predominant. As it goes up towards 100, it tells us that buying is predominant. The midpoint between 0 and 100 is 50. So think of 50 as the equilibrium line. When the RSI crosses 50 and goes above 50, that tells us that markets are now finding more strength for the buyers because the equilibrium has now been crossed in favor of the buyers as the line goes up. When the line crosses below 50, it tells us that the sellers are now becoming stronger because the equilibrium line has been broken on the downside, pushing the line lower. So think of 50 as a line at which buyers and sellers are matched almost equally. So perhaps you can also think of the value of 50 as a midpoint line of support and resistance, depending on where and how the RSI acts. The RSI, according to builders, has a very special quality, and that special quality is divergence. In his book, Builders explained how the RSI diverges from price. When price makes higher highs and the RSI goes up and makes lower highs, there is a bearish divergence, a negative divergence. And that tells us that momentum is now falling and it is not obeying the price rise. That is a sign of a decline or a sideways movement or a stopping of the uptrend. Similarly, we have a divergence on the downside. Prices may be making lower lows when the RSI makes higher lows. So the RSI is telling us that it is not following the price which is making lower lows. It is showing strength because higher lows indicate strength. That is a positive divergence which tells us that markets are perhaps bottoming out, they are oversold, and we can expect either a sideways or even better, a bounce or a rally in prices. So Builders had two themes on the RSI. The first was he defined two boundaries, overbought and oversold, or that is 30 and 70. He said when prices go above 70 and come down, that tells us that the overbought position of the market has started now weakening and prices are likely to fall. So 70 was his threshold. The RSI goes above 70 and starts coming down, breaks below 70. That is a sign of weakness, that the strength that we were seeing is now dissipating. The second line is the 30 line. So when the RSI goes below 30 and again goes up and crosses 30 on the upside, it tells us that the weakness in the RSI, in the prices, which the RSI was denoting as it was falling, that weakness has come to an end, and the crossing of 30 on the upside is a sign that the oversold position will end. Now, it also means that when the RSI is at 70, prices are high. So if you want to sell, you are selling into strength when the RSI crosses below 70. When the RSI is below 30, prices are low. And when it starts crossing above 30, you are actually buying weakness. Now for many traders, the idea of buying weakness and selling strength is very attractive. One of the ways in which the RSI can actually be used is the exact opposite of using it as an overbought, oversold indicator. In this method, and this has become a fairly reliable way of using the RSI is actually used as a trend indicator. How is it used as a trend indicator? The default value of 14 is generally used for the RSI to identify the trend component. When the RSI goes above 60, an uptrend is signaled. Now, it is very different from the original use of the RSI as a momentum indicator. Above 70, the market is stopping. Below 30, the market is bottoming out. That was a separate issue. This is very different. Once the RSI starts showing strength and actually goes above 60, that is the point at which a new uptrend is signaled. What essentially I think it means is that the RSI is showing strong price action on the upside. That's a buying signal, that's a buy signal. When the RSI goes below 40, a downtrend is signaled, and that gives the sense that the RSI is now signifying very weak price action, so weaker prices should lead to even more weaker prices. So now we have the trend component in the RSI. When the 14 period RSI goes above 60, consider buying the security, when the 14 period RSI goes below 40, consider going short in the security and of course in covering your long positions. That goes without saying. Is there an earlier exit? When it goes above 60 we buy. When do we exit? Do we wait till the 40 level or do we exit before that? That question remains a judgment for the trader. There are two ways to exit the RSI once you use it as a trend indicator. The first is if the RSI goes up and goes below 60. That's the first signal that the strength is now coming to a standstill. That's the first exit. And the second exit is, of course, if the RSI goes below 40, you have to exit your long positions. Whether you take short or not is a different matter. When the RSI goes above 60, turns down and then starts falling below 60, there are actually two possibilities. One is that the trend is over, you exit and that is the end of the story, the trade has been completed. There is a second possibility that this is only a dip or a correction in an ongoing uptrend. So if you are looking to capture a long trend, then you do not exit below 60, you wait patiently, your exit is below 40. Otherwise, you accept that all trends will go through corrections and you accept that correction. When the RSI goes below 60, then turns and goes above 60 again. So you accept that downturn in the RSI as a normal part of the trend and you stay in the position. So you must have perception of the trend. Is it a sideways market? In a sideways market, when you have an uptrend, the RSI goes above 60, buy. When it starts turning down and going below 60, close your position because the trend is very small. But if it is a strong bull trend, then you need not exit if the RSI goes below 60. You accept that as the normal dip or correction in a strong uptrend, in a strong bull market. In that case, your exit is only below 40. Almost the exact opposite is when the markets are in a downtrend. When the RSI goes below 40, if you perceive that there is a short selling opportunity, you short sell. If you are in a sideways market, you cover the position when the RSI turns and starts going above 40. If we are in some kind of a bear market, then you wait and let the short selling continue until the RSI goes above 60. In some cases, the RSI never goes below 60 for weeks and months altogether, and your short positions can continue. The same applies to long positions. If you are a long term or if you are carrying a positional trade, the RSI may not go below 40 for months. So all the dips are simply you are testing your patience. You stay with the position. So depending on your trade outlook, a sideways market or a strong trending market, you would use the exit. But the entry is simple. Above 60 is an uptrend, below 40 is a downtrend. To get regular updates to this channel, subscribe to the channel and press the bell icon.